The information provided on this podcast is intended to be educational and informational only and is not considered to be formal legal advice. The listener should not take or refrain from taking action based on its content. Any listener in need of legal opinion upon which to rely in decision-making should consider formally engaging an attorney to review relevant facts in detail and examine the pertinent law as it applies to those facts.
Welcome to Real Estate Milestones, where we explore fascinating topics in commercial real estate with knowledgeable industry experts. I'm your host, Ben Malech, and I'm a young real estate professional who is passionate about adding value to people's lives through the incredible power of real estate. My goal is to help you discover what the heck is going on in the industry and how you can get involved. This is Real Estate Milestones, where your future in real estate lies just around the corner.
Hello, everybody. This is Ben talking to you guys from Potomac, and we have Anthony Scandariato, founder of Red Knight Properties and host of Discovering Multifamily Podcast. Before I let him introduce himself, I want to tell you a little bit how I met him. And so next week, you're going to meet Mike Strug, one of my mentors, who I guess has really helped me learn a lot about real estate. And he actually introduced me to Anthony through his program YREP, where he had Anthony speak about his company and about his journey on through multifamily real estate. And I was like, wow, multifamily real estate, that sounds super interesting. I kind of always thought about, little houses, but now you have someone who's, owning something bigger than that and doing something bigger than just, residential. So I was really interested. I listened to like probably half of his podcast episodes before reaching out. And Anthony was nice enough to get on the phone with me and tell me a little bit more and help me learn. And I think this is a really cool full circle moment because he was the first podcast, or his podcast was the first I've ever listened to. Now I have him for the first episode. So it's an incredible honor to have him. So Anthony, take it away.
Excellent. Thank you, Ben, for having me. Really appreciate the back and forth, reciprocation, and you come a long way from when I first met you not too long ago. When your growth and your development is pretty amazing. So keep up the good work.
Thank you. Will do.
But yeah, happy to introduce, Ben did a good job introducing me. But my name is Anthony Scandariato, and as Ben said, I'm the founder of Red Knight Properties, one of the founders. And we specialize in acquiring and managing value-add apartment buildings up and down the East Coast. So mostly apartment buildings anywhere from all the way, I sit in New Jersey, so basically from New Jersey down to Florida. And we have about almost 700 units in our portfolio, assets under management of about 70 to 80 million, give or take. And, we're acquiring mostly Class C type of assets that we're taking up to Class C plus, B minus, through strategic capital improvement plans. And we're partnering with investors as a group, via syndication model to acquire these assets together and split the profits. So our typical deal size is anywhere from $5 to $20 million per transaction. This is on a deal by deal basis. I don't have a fund set up. And, the property sizes are anywhere from 50 unit apartment complexes to around 200 unit per deal sizes. So very middle market-y, not there is competition, but less competition than some of the institutional players that buy only 300, 400 unit plus complexes and way too big for the small guy that is buying 5 to 10 unit buildings that may overpay. So we got a decent niche that we're targeting, and it's mostly in areas I like to designate as workforce housing, growing secondary markets within an hour or two of a major metropolitan area. So that's a little bit about what we do. We also, like I mentioned, we have property management division as well. So we it just means we self-manage. We don't outsource the property management portion of our company to a third party. And yeah, as Ben, mentioned, that we have a podcast called Discovering Multifamily that, Ben is a listener of, and really appreciate that. And looking forward to seeing how this goes for you, Ben.
Yeah, thanks. Definitely. And as of now, I definitely recommend, if you want to learn a lot about real estate, to listen to Discovering Multifamily. But hopefully this will also be a good source of equally good content.
Would be to learn as much as I can over, whatever time period that may be, and was to buy my first deal on my own, with just myself, so I can learn. If I made a mistake, it was on my dime, nobody else's, and I was able to do that. So, second milestone, I bought my first property. My first deal was a two-family house in New Jersey, in the same town I grew up in, and it was a great deal. I actually still own the property today, and bought it. I learned a lot. I was the self landlord, self attorney. I had to evict both the tenants as soon as I bought it. They were not paying, and learned a lot through that process. Learned a lot about landlord tenant law, particularly in New Jersey, where it's, some areas are not as landlord friendly; they're more tenant friendly. But that that experience really springboarded my love for the asset class. I saw what type of income, passive income it was bringing in, and wanted to scale it. So the milestone from there, the third milestone would be to partner on a deal with somebody else. So I actually bought a two-family house with another partner in an area where I knew very well, and we basically fixed it up. We re-rented it, and then we sold it. And we had, it was like a 40% IRR and over like, I think it was 14 months, and we didn't want to keep it. We just sold it because the returns were just crazy. So we bought and sold that. That was, another milestone. So I was able to bring in a partner and go full cycle. And then I ended up meeting my now business partner, and, bought something a little bit bigger, a 10-unit building. So basically from there, it was, a two-unit to a two-unit on my own, with 2-unit with a partner that we basically flipped, and then a 10-unit with my partner that we ended up adding really massive value to, that we did a cash out refi, and then we bought another 10-unit from there, and then we bought a 20, then we bought, I think it was another 13 or so, bought about 70 units together, and was able to go somewhat full cycle. I mean, a refinance, not really full cycle, but was able to get the capital out and put it into more deals. And then we ended up, the next milestone was we ended up syndicating. So basically acquiring a larger property, and buying it with a group of partners and splitting the profits. But we're obviously operating it and doing the day-to-day management, and managing the investment. So basically was able to do that in late 2019, after, acquiring those deals on my own with my partner. And so that was a major milestone that we hit in like December of 2019. Left the company I was working for in January 2020. We had another deal. We got under contract as well, kind of at the same time, the same market. So basically from there, that was, the next milestone was to kind of pursue this full time. And then, now we're up to, at that time it was, with the syndicated deal, it was like 110 units, 120. Now we're up to almost 700 units, basically on our own through our network. We generally, don't really co-GP, give or takes, partner with other sponsors. Sometimes we do, but it's mostly our network we're partnering with, and that's obviously continuing to grow.
Yeah, that's amazing, and there's a lot of good stuff to go in there. And I kind of heard you hit on this a little bit, but maybe we could flesh out a little bit more. But I remember I was amazed when I first learned about the BRRRR method on your podcast. Sounds like you touched on that a little bit, but could you go in a little bit more detail and kind of explain what that is?
Yeah, a BRRRR method is basically buy, rehab, rent, refinance, right? I think.
Yeah,
And
sometimes you got the repeat in there,
and repeat. Got the last so basically, you take a property, and I'll just use one as an example, that we did. The first one we bought was actually, I'll use a larger example. So we bought the syndicated deal. This is December 2019. We bought it for 5.5 million. We put in about $500,000 worth of improvements. Interior renovations, kitchens, bathrooms, floors for the most part, exterior renovations, monument signage, landscaping, hardscaping. And we also added 3 more apartment units that weren't there. So a little bit of development or redevelopment. And so we were all in about 6 million. And the net operating income increased over basically a 12 to 14 month period from call it 300,000 to 600,000. And we were able to go to a bank, go to a lender, and get them to appraise the property. And it appraised for 9.7 million. So what we ended up doing was we took a loan from the bank. I know what the exact amount is, but we took a loan from the bank and we basically paid our, investor base, the down payment that they put in. So they got all their money back, plus they got profit. Now we're distributing cash flow every quarter. And we were able to put that money, the money that they got back, that repeat part, they were able to put that money into a new deal that we found. So they basically own two properties for one investment. Now you could continue to keep doing that on your own. One thing, and it's tax free to take the money out. You eventually have to worry about that at some point if you were to sell, but you have to worry about being over leveraged. You want to make sure it makes sense. Maybe it does make sense to sell sometimes. But if you want to continue growing your portfolio, this is a good method to use.
Yeah, that's awesome. And yeah, definitely a cool thing to dig into and learn more about, and can really help scale a real estate business. And just for the sake of clarifying for everyone, we've been talking a little bit about the syndication model, and I thought that was really interesting when I learned about it, because now I used to think it's only like Blackstones and huge companies that can own these pieces of real estate. And I didn't realize that, someone like me or you or Anthony could even get into this business. And then I learned about what the syndication model was. And it's pretty much, you have someone like Anthony, do most of the work on the business. You kind of just join in with your capital, with your money, and are able to invest in real estate. And, that you pretty much do something you couldn't do by yourself by partnering with other people. And if, Anthony, you want to clarify what syndication is a little bit more, just for clarity, please do.
Yeah, you hit the nail on the head. I mean, I wouldn't have been able to buy that $5 million building on my own. So syndicating, bringing on additional partners. I think we had maybe 20 partners, just regular people that worked in real estate, worked in insurance, worked in as a lawyer, doctor, whatever, a marketer, all just people that had good jobs, even some businesses, and they wanted to kind of divest a little bit out of the stock market or just reallocate some capital towards hard assets. So they're able to do that. And basically, there's a buy-in into the property. So let's just call it $50,000 as an example. So everybody would put in whatever, 50, 100,000, whatever the total down payment is. If it's $2 million, everybody's putting in 50 or 100,000. I might have maybe 20 partners or so, maybe 20 to 25, but these are all people that myself and my partner know very well. And we trust, and hopefully they trust us. So, it's really good to also spread the wealth around. And like you said, not keep it concentrated at a Blackstone or, some other conglomerate that owns, commercial real estate. So that's the beauty of the syndication model. And all these, investors that I have are all passive. A lot of them are, I would say, a little bit older, maybe 50s, maybe 60s, some in their 70s. So they're not necessarily wanting to do this full time. And then even the younger crew has full-time jobs. They don't have time for this. So that's generally who we cater to. And it's been really good. We've been helping people. I have some younger investors, 21, 22. I had one 21-year-old invest $50,000 in one deal. It was the first deal that we did, and we kind of turned his money over on that a couple times already. So really cool to see young people start out early in real estate, and they're going to be hopefully multimillionaires just through some of the investments that we've made. So it's really cool to see that and to kind of change people's lives through this as well.
Yeah, that's awesome. And when I first heard about this, process, I thought it was pretty revolutionary, because a lot of people listening to this might think, you just put your money in the stock market through your investment broker, and down the line you take it out. And also that like all these super wealthy people, most of them own real estate, and you don't really see how that could be you. And now, like when I heard about this model, like you can start with $50,000, where you'll get monthly cash flow checks coming in every month. just, I guess for knowing the right people and, having a will to be in real estate. And I think that, it's hard to diversify just in the stock market in one asset type, but, it's good to have exposure to
Yeah.
these other asset classes, especially with, the advantages with real estate, with taxes and, cash flow and just, appreciation. And I think the best part, the scarcity, there's a limited amount of real estate always. And, that's kind of one of the most beautiful things about it.
Sure. Yeah. Scarcity. That's a good point. I haven't heard that in a while because you can't really create new land. It's just whatever you got to work with what's there. So, um, yeah, I really love the asset class, and the tax advantages are key as well. There's not a lot of assets that allow you to depreciate and get some bonus depreciation and some other advanced topics to help offset some income. So yeah, it's really like it.
Yeah, definitely. So, going forward, what are, could you tell us a little bit about what you look for in a deal and, I guess what's a deal breaker and what makes, a deal, look perfect for you?
Yeah, I wouldn't say you don't want to look for the perfect deal because then you won't buy any deals.
Definitely see
But you,
that.
you do have to be cautious too. We run sensitivity analysis on every single deal that we have. What happens if the rents drop 10%? What happens if interest rates go up 300 basis points? What happens if there's 20% vacancy for the 2 years? So we have those analysis. We always just try to put maybe we call it base case scenario when we're presenting a deal. We don't go crazy with our inflation projections. We do on the expenses though. So we try to be conservative with our projections as much as we can. And if the deal still makes sense, then we'll buy it. So we're not looking for a perfect deal, but we want to make sure that our downside is protected. So downside meaning your principal. Make sure that your principal is always protected. You're not putting 100,000. You're not going to lose that. So I'm always worried. Not worried, but that's always a concern that I have every time I look at deals, just to make sure that's the case. Because you know, um, some people haven't seen the cycle yet in the industry, and it's slower than most industries when it turns around. But you want to make sure that downside is always protected. So those are some of the things I look at. We look at in place cash flow with the existing rent roll. We're usually buying occupied buildings, so there already is cash flow. Can it support the debt? Um, how much upside is there really to the rents after we make improvements? We don't just want to buy a building and just raise the rents. We've done that before, but it is good to have a mission behind it too. So how much capital improvements do we need to spend in order to get an ROI on those dollars? And where's the market? We look at the markets too. What's the population growth look like? What's the employment base look like? What's the labor force look like in terms of projections? What is it, landlord friendly market? Those are kind of things that I've always looked at. And what's the incomes, median incomes for the area? Are they growing? So we start with the market, and then we look at the asset level. How old is the asset? How much improvements do they need? Is it structural improvements? Or is it mostly cosmetic? A lot of different things we look at. Replacement costs, the three approaches. You got replacement costs, income based, sales based. So we look at all of those as well. So there's so many different factors. It's not just one.
Yeah, definitely. And a smart guy that I like to learn from, Hunter Thompson, like to say under promise and over deliver. It sounds like
Yes.
with your base case scenario and really being, I guess, diligent and cautious and not over promising is definitely key, especially given how important relationships are in the real estate business. So sounds like you got a good grasp on that for definitely, and definitely good for credibility and yeah, I guess just the business in general.
Yeah, for sure. You definitely want to under promise and over deliver, if to the best of your ability and your projections. And just gotta, I've seen some crazy models. We were talking before about sub 3% cap rates, and I personally we never really bought anything really less than a six cap, maybe a little bit less in any market, even in the market we're in now. It just never really resonated with me to buy things in the fives or the fours. Um, so we always kind of look at that's part of the reason why we've been buying Class C. But It all depends upon the market. You wanted my opinion on interest rates right now. Federal funds rate is basically near zero. I think their target by 2022 is still a little bit less than 1%. It's like 0.9. So you're looking at probably 3 rate hikes next year. That's not going to kill the market. It's going to cause a slowdown, and I think it's going to remove a lot of the people who started when the Fed really, you know, used quantitative easing policies in the beginning of 2020. It's going to remove a lot of those players because they don't know how to act when the rates are higher and markets kind of went down. So, real estate investors, you always want to set yourself up for inflationary risk and different um, market dynamics. So, having fixed rate debt at cheap cost of capital is important, especially if you're planning to hold it for a little bit. And you don't want to be too over leveraged and take on variable rate bridge debt because when the rates go up, you could potentially be underwater, and you're not going to hit the rent projections you thought you were. So it's always good to just have a somewhat conservative approach to your underwriting every time you're looking at a deal.
Yeah, and something you were saying there before, I mean, I'm an analyst in multifamily. Partly got into that after getting super interested listening to the podcast. But I look at properties often, many a week, and some of these things, or I send some LOIs on some properties, and some of the properties that I lose are value add, classy, kind of like what you're talking about. And I lost to someone who took something like the 4 cap or something like really low, and I'm like since when does the value add multifamily take like core and core plus I guess cap rates? And I know it's partly because people are building in the value that they expect to add into their projections, but you know you're also kind of diminishing the fact that the value that you're adding that you want to have higher returns are also includes risk. So like some people I feel like might be discrediting some of the risk associated with adding value, because there's a lot of unknowns, right?
Yeah, and cap rate's not a one size fits all metric. So people who are buying 4 caps, they may be able to take it to a 9 and they'll be good. I haven't seen that. That's a lot of uh, cap rate expansion through your yield to cost, your renovation plan and your stabilized NOI growth. But I've seen some deals that get passed across my desk that are going in at a 4 cap, and then their yield to cost is maybe a 5, and then they're selling at a 3.5, and it's like a 15% IRR. I'm like, that's crazy. I would never ever show that. So I and that's on maybe Class B multifamily. So we kind of like being in the C. Like you said, it comes with a little bit more risks. Um, Maybe a little bit of rougher tenant base. We try to go in and we improve the assets too, and improve and elevate the tenant base, or at least train the tenants that are there to kind of take care of the property a little bit more. Um, and then obviously comes with rent increases. We try to figure out ways to reduce operating expenses too. So it's definitely a niche. Like you said, Class A core assets. Definitely. I've seen 4 and 5 caps on those, but not much upside. So it depends on your borrowing costs too. And I think you might see a lot of those deals kind of not really come out to market in 2022 because they're not going to get well, maybe in 2022, yes, but 2023, when rates rise, is going to be a little bit more difficult to uh, substantiate the values some sellers are probably looking for. But those are all the core deals are mostly longer term assets anyway, so they may not care. Um, but like I said, the value add deals usually I'm looking at depends upon the market, but 3 to 5 year time, mostly 5 year time horizons. If we can get the capital back through refinances beforehand, then great, put it in something else. And we can kind of be flexible because all our money's out, but how long we hold it for, as long as we're not over leveraged. And it depends upon each business plan, but the sooner you can add value to the buildings, the better off you'll be, even when markets start to turn.
Yeah, because you're kind of building in the appreciation or adding the appreciation, or I guess you like to say forcing the appreciation rather
Forced
than
appreciation.
just
Yep.
right. You don't just wait for the market to increase asset prices, but by actually making the income higher, you increase the value of the asset because the income is what determines the value of the asset ultimately.
Yeah, I mean, you see a lot of people. We've had, almost record inflation numbers for 2021, and you see a lot of people just forecasting inflation, 10% inflation almost indefinitely. That's not going to happen. Well, maybe it depends upon what's going on, but it's unrealistic, and it's much better off to take a building that has $500 rents, which is not market, even pre-pandemic, to $1,000, and and that's still in line or below other comps in the area, and below replacement cost. Our average rent across our portfolio is probably around $1,000, which is why I say that. So that's generally what we're doing, and some people who are buying more of the A product, and we saw those rents go down in a lot of markets, including even the hot markets like Florida. They still went down like 10%, give or take, on the A product. The Class C went up. We saw that last recession too. The rents went up, values went down, but the rents went up. So it's a kind of chicken or the egg situation. But I do like the workforce housing asset class. There's not enough supply to meet demand, and you can't really build it because it's too expensive, and it's not affordable. So I like the fundamentals of the asset class.
Yeah, and so you're going to touch on something I really wanted to ask about. First, I wanted to mention just based on our conversation just there, a wise man once told me that you can always you can always or you can never fix your purchase price. You can always fix the interest rate that you're paying on your loan. Or I mean, because I guess now if you bought a property for a lot cheaper 10 years ago, you can refi into an interest rate now, and nowadays people are taking advantage of these low interest rates, not realizing that they can't fix the price that they paid for it, even if interest rates go up. So I thought that was an interesting point to make based on what we were just talking about. I also wanted to talk to you a little bit about the market and how changes in the market affect your criteria. And I know you've spoke a little bit about workforce housing, which I guess kind of appeals to the people who might not be able to afford the most expensive and luxurious things. And I feel like that might be helpful in a recession because there might be more demand for products that are less expensive. So I wanted to see if you thought that rents would still increase if there was a downturn in the market, and or how's your criteria changed given what may or may not happen in the market.
Yeah, it's I wouldn't say it's recession proof, but just looking at historical trends, 2008, 2009 on some of the C product, it did hold up. Obviously, during the pandemic, 2020 held up, 2021 held up. So that obviously brings comfort to us, and moving forward, I think just given the fundamentals of supply and demand for the type of product, it's still going to continue to go up. And it's obviously a little bit of a hedge against, well, it's a hedge against inflation. I don't think we're going to see a recession 2022, although I think there should be one. That's a different topic, but I don't think it's going to happen. It'll be, if it slows down, it'll slow down, but there's not going to be, I don't think there's going to be a wide recession. But even if there is, and you're able to charge the same rents that you were charging now, as long as your operating expenses didn't go up a crazy amount, you should be able to weather the storm, and you didn't take on variable rate debt. That's, at 90% loan to cost. You should be fine. And you have adequate reserves, even if you want to weather, let's say we do go into recession, it's a 2-year recession or 3-year recession, and you took on 10-year debt, you can weather the storm. You just have to be very cautious and careful. And that's where asset management comes into play. Really robust asset management. So those are the people who are going to win at the end of the day. There's a lot of people who made money, including myself in 2020 until now, that might get wiped out. because they didn't really understand that this market's not going to be around forever, and they did some things that they shouldn't have on the financing side or on the purchasing side. So we'll see, but it'll be interesting.
Yeah, definitely. And I mean, if, I wanted to kind of see if you had an opinion on where you think inflation might go. I don't expect you to be, the an economist that has glass ball, but it's cool to kind of hear people's perspectives on what may or may not happen. Because a lot of people are saying maybe inflation, or I guess the government is in trying to, inflate away their debt. I kind of feel like, in a way, printing money is a way of taxing us because it decreases our purchasing power. It's not like cutting our paychecks, but it does the same thing. We can buy less and, with the same amount. So kind of wanted to see if, like, I know a lot of people are in real estate because they want to be the beneficiary of rising rents, rather than the person who's paying the rising rents. But do you think that if rents can continue to inflate, and you could always be the benefactor of inflation, or do you think inflation might have a big impact on asset values?
Yeah, I mean, it is real estate is multifamily real estate is definitely hedged against inflation. It's not a foolproof hedge against inflation because if your rents go up 10% and your taxes go up 20%, and that makes up 50% of your expenses, it's a net zero. You didn't gain anything. So you really have to, you know, really watch everything going on in your operations when there's high inflationary periods. Um, we experienced it a little bit on some of our assets. But again, it comes down to where you bought it at, and how are you able to take that asset from point A to point B and add the value, and then you're kind of you're in a good spot from there, hopefully. Um, but yeah, it is beneficial. I mean, it is a hedge because rents during inflation don't really go down. Where I think inflation, I forget what the inflation number is for 2021. I mean, we're almost at the end of the year when we're recording this, but I think it's like 7 or 8%. I think that's a lie. I think that rents aren't really included in there. I mean, the lowest rent increase that I've seen without even doing anything is like 10%. And I talked to many other operators about the same. So I think the real number is probably maybe 10 to 11% on inflation for 2021, which is scary. Um, and moving into 2022, once the tapering starts, if it happens, if they actually are true to their word, it'll. Yeah, I think they're a little bit late in the curve, to be honest with you. I have my opinions, but it'll start to come down. It's still going to be high. It's not going to be 2%, the long term, risk adjusted inflation rate that they're looking for. It's still going to be in the 5 or 6% range. So you do want to have assets that kind of ride with inflation. Real estate is one of them. There's a lot of asset classes that don't go well with inflation, that you just said, with higher consumer prices, because it is a tax. It's a regressive tax, inflation. But the thing you really have to look at too, the other side of the argument, is wage inflation. So if wage inflation is not keeping up with just rent inflation or CPI inflation, that's the problem. Right now, we haven't, wages are keeping up. I think they're actually lower than, I think it's like 2 points lower than inflation. So yeah, you are actually losing, purchasing power at the end of the day if your wages aren't, covering that extra tax. So we're going to see more of that. I think that, there is a supply issue in the labor market. So we are going to see wage inflation moving into 2022. But the interesting thing to see is if it keeps up with regular inflation. I don't think it will, but we'll see what happens.
Yeah, definitely. And I appreciate that commentary. I think we hit on a lot of the reasons why I started this podcast and why I find real estate in general so exciting, just from, I guess all these interesting, ways that you can interact with different economic trends, and just, some, in a way, you can predict your stability on the front end. And I mean, there's obviously variables that you can't attend for, but there's a reason why it's a very attractive asset class, and why it's been one of the most coveted things for as long as we know, and part of the American dream, and yeah, a lot of exciting stuff. So shifting gears a little bit, I want to tell a little story. So the first time I actually met Anthony in person was I was on my way to New Jersey, New York to see my grandparents, and Anthony was having a in-person networking event. I was like, "Ooh, that's really awesome! I'd love to meet him in person and meet some of my other contacts that were our mutual friends in person." So I go to this I come over to this event, and long story short, I was 20, so I wasn't able to get in because it was at a bar that was for 21 plus. So I kind of waited outside and chatted with some of my friends who were there, and then when the bouncer left, I was able to come in and meet Anthony. I was like, wow, this is an amazing event. Like the venue is super cool, and everyone seemed like they were having a great time. And looks like there was a lot of good networking going on. And I was like, one day I want to throw an event like this, and hopefully I'll be old enough for my own event. But yeah, so I met Anthony there, and that was a great experience. But Anthony, I wanted to. So actually, one more thing. My two of my friends and I at Tulane are starting a networking group for professionals, alumni, and students all to interact at do a similar thing as what you did at like a bar or a restaurant. And yeah, I wanted to hear how you make sure it's a kick-ass event and how I can make sure everyone has a lot of value from it.
Yeah, I remember that. That was a fun event. I'm partnered with a mutual friend of Ben's and myself. Run a group called the Young Real Estate Professionals of New York. It's kind of like the New York metro area, so we'll have events in the city, mentions events in New Jersey as well. It's about, if you want to run a kick-ass event, you just gotta keep your face out there. It's about your brand too. So if people want to hang out with Ben, they'll come. And if you're hosting it with two of your other friends that also have a good reputation and good brand, then they'll come. So it's all, this industry is a lot about reputation as well. And you kind of do what you say you're going to do, because if you don't, it's going to get around and then it's going to affect your business. So that's kind of one piece of advice. But yeah, that's what I would do, and I'm sure people would come, especially with alumni and some other invitees that you might have on the table.
Yeah, definitely. And I think networking sounds to have been a huge tenet of your business. And I think it's been one of the most important things for me. And that's part of the reason why I started the podcast, because I really love to, chat and learn from people. Being 20 years old, almost everyone has more experience and knowledge than me. So I'm just constantly absorbing, good advice and good knowledge from others. But I really like the idea of, helping other people meet other people where I'm not necessarily in the conversation, but I brought two people together and they just made like a great relationship. And I feel like I'm always gonna be a part of that, even though I wasn't actually a part of that. Where that's what I kind of like about and I think you've said this before, but about hosting a networking event. And I just love adding value to people's lives. And I think it's really good to be able to do that. And I mean, I think what goes around comes around as well. And I'll be able to learn a lot and have a lot of value for myself. So yeah.
Sure.
Definitely. So we're gonna wind down soon, or we're gonna start winding down. But I want to give you the lightning round of questions. So I guess it's the first official lightning round. They're gonna get increasingly harder as we go. So are you ready?
Ready.
All right. So if you could have any superpower, what would it be?
I think it would be mind reading.
Nice. That's a good one. Why would you? What do we want to use that for?
Well, you could use it in real estate. You kind of call sellers bluffs. I have 10 offers and they really have none. That would be great.
I think we might have gotten into this. We might be getting into this in some later episode, but you can't always trust what the broker says, and I've learned that the hard way, I guess. But yeah, but yeah, I mean they're all nice people. And so I guess the next question is, what's your favorite book, or what's the one that helped you most in real estate, or just in life?
There's a few of them. A really good one I thought is not necessarily real estate related, but it's called The Miracle Morning by Elrod. I'm sure you've heard of it. Pretty renowned book. Really helped change my life, just through disciplines each day that I still implement. Sometimes I'm a little busy, but when you kind of deviate from it, you can tell the difference in your day to day. So it does work. So that is one.
Yeah, I agree. That's I haven't actually read the book, but I know a lot of people who's given me the advice that I know trickled down from it. So I definitely want to go to the source and read that one. And thanks for sharing. I'm always trying to learn, so I like to. This is one of the advantages of having podcasts. I get to ask a lot of people what their favorite books are. And so next, what motivates you to continue doing what you're doing every day?
I like changing different people's lives in different ways. So as I said before, we're not catering to on the investment side, we're not catering to Blackstone. This is really my network. Some of my closer friends and family members are in my deals, and to help transform their lives through their wealth is great. And then even tenants that we have, tenants, appreciate most of them, at least the good ones, appreciate some of the improvements that we're making, and really helps change their communities around. So both of them get me up.
Yeah, that's awesome. And one of the first things that drew me to real estate was the fact that value can be added in a really big way. And so that's awesome, and definitely something that I love about it. And so lastly, what advice would you give to someone who wants to follow in your footsteps?
Yeah, I would say there's not a one size fits all for everybody. You can go out and buy your own property, very similar to what I did. You can work for somebody. You can partner with somebody more experienced. You just have to bring value, or you can invest with somebody. There's so many different ways to get started in real estate, particularly multifamily. So just keep an open mind, and not one size fits all.
Yeah, awesome. And I guess so. Since I just put you on the spot, I'll give you a chance for revenge. So feel free to ask me anything you'd like to know.
Say that one more time.
I said, since I just put you on the spot, I want to give you a chance for revenge and allow you to ask me anything you want to know about me.
Oh, great. When are you going to buy your first building?
Oh, that's a good one. Yeah, I've been looking around a lot, and hopefully as soon as possible. Hard to predict when, and but yeah, I mean, I think I definitely have, through the last couple of months working as an analyst and listening to podcasts or reading books every single day, always learning. Like, I definitely have the skills to start putting things into action where I'm confident that I'll be able to execute on a plan that I know at least enough to get started. I know, but I really want to get started so I can start learning some more. So partly the market scares me a little bit and it's giving me a little bit of analysis paralysis, but I know I think I have what it takes to find a deal that I know would be good regardless of market conditions. So yeah, I think that I'm going to keep looking at where I think it's attractive, and hopefully find something that fits into my criteria, and I can under promise on and over deliver for my friends and family, because I don't think I have exactly all that it takes or financially to get into my first deal. But yeah, I mean, I'm really passionate about making sure that I'm not taking too much risk, or just like you said, you don't want to lose your friend, the money of the people who you care about most. So, but yeah, I've learned the power of due diligence. So that's definitely a key for me. So
Excellent.
yeah, so short answer is as soon as possible. And yeah, I'm super excited for the journey, and I want to start compounding my I guess my wealth at this young of an age. And I think you've said it, and everyone who I've spoken to says it. I should have gotten started younger, and I don't think I can say that. Hopefully, I don't have to ever say that. I'll start saying
Yeah,
it
you won't have to say that.
awesome. And yeah, I guess I'm already compounding my knowledge and growing a little bit each day.
Great.
And yeah, so Anthony, it's been an incredible honor to have you on as our first guest, and I think everyone's going to learn a lot from this. And it's definitely been super exciting for me. Anything you want to, any last words you want to share, or if anyone can reach you, if you have any places that might be good for that?
Yeah. Well, thanks again for having me on the show. I hope it's long and successful, and best of luck to you in your career. Yeah. And if anybody wants to reach me, you can just, our website, we have a special report on there. It's like how to achieve financial independence through real estate investing. So you can just go on redknightproperties.com. It'll pop up so you can download that. You should get an email with the ebook, and then I'll have all my information on there. But you can also find me just on Facebook, LinkedIn, Instagram, Twitter, Clubhouse, you name it.
Yeah, and you can listen to Discovering Multifamily on Spotify and all the the major streaming services.
That as well.
Okay.
We're on iTunes and Spotify, Stitcher, Google Play, kind of pretty much every platform.
All right, and so to close out, can you give me your best closing from discovering multifamily? I like the thing that you repeat every time, so I wanted you to say it for the people listening.
The best closing from discovering multifamily?
You like to mention give us a like and review on iTunes. That's how it works.
Yes. Please, when you release this, like it and review it on iTunes because it helps us get our message out to a greater audience. That's the way it works.
That's just how it works. I love that one. It gets me. I've liked and reviewed yours, so hopefully I'll get one from Anthony. That would be a good endorsement.
Great, awesome.
All right. Well, thank you, and thanks everyone for listening and spending your time with us. And I'm looking forward to learning more with you in the future. All right. Bye-bye. Thank you.